Welcome to the monthly fixed income outlook. We saw monetary policy on 30th September. In the monetary policy, the MPC raised rates by 50 basis points. This is the third consecutive 50 basis point rate hike by the MPC. Since May 2022, they have raised rates by 190 basis points. And if you also consider that the corridor was narrowed, the effective rate hike becomes 225 basis points. RBI seems to be comfortable with the growth right now, and inflation forecasts have remained unchanged at 6.7% for FY23. But from an overall growth perspective, if we look, our growth recovery is in the K shape and is gradual versus the large shoot that you saw in the developed markets because of the policy response, which was much lesser than what we saw in the DMs. So we are experiencing a K shape kind of recovery, but we are still below the trend growth where we should have been. From a global growth perspective, if you were to look, as we discussed, the global growth had shot up. So the global growth momentum is slowing down now, and you've seen that the PMIs have crashed over there from the highs that we saw, but they are still above 50 on an average basis. From an inflation perspective, global inflation continues to remain elevated. It is not only the energy complex which is dominating it, but it is also the core part of inflation which is contributing to this rise, despite your supply chain pressures which have come down from where they were on their highs. So supply chain disruptions have come down, but still your core inflation is contributing to a large part to your overall inflation, and inflation remains elevated globally. Now, as a response to this inflation and growth conundrum, you have seen DM central banks have started to front load rate hikes because they seem to be behind the curve if you compare inflation versus the Fed funds rate or ECB rate versus their CPI. So as a result of that, you've seen that global bond yields have shot up, and which has also caused some kind of increase in rates in the emerging markets, because emerging markets are in some sense a corollary of the developed markets. If you look at from an India perspective, your liquidity started to tighten. Your liquidity in the banking system, which was running at a surplus rate, is now moved to neutral. Your incremental credit deposit ratio, which signifies the amount of credit the bank does versus the amount of deposit that the banking system is then doing, is already above 1 at about 1.2 times, which is also contributing in some sense to the draining liquidity and increase in the short-end rates. From a gilt spread perspective, if you look at the 3-year GSEC and the 5-year GSEC versus the repo, your term spreads are elevated above the median levels in the long range that you see. And on the flip side, you're seeing that corporate bond spreads are below the median or long-term median levels, and they continue to remain muted over GSEC. From a FX reserve perspective, RBI has spent some currency in defending the rupee, plus you had currency revaluation. So from a overall reserves perspective, we are at about $530 billion, and from import cover, which is measured in the number of months, you are seeing that the import cover has dropped from the highs that we see, but we are at a comfortable position. But one needs to be watchful of further drop in FX reserve, which can cause some concern in the rupee. And if you were to summarize all of this macro into one and give our take, it boils down to what we think is RBI's monetary policy action will be dominated by the external sector more than the inflation and or maybe the growth, because RBI is comfortable on the growth. So from a pecking order perspective, will be external sector first, second inflation, and third growth. Terminal rate, given global macro situation is very dynamic and changing, we are expecting as of now terminal rate to be around 6.5%, and the long end yield bond yields up to the 2027 piece, where we saw the term spreads are elevated, continue to look attractive to us from a risk adjusted basis. And since the global dynamics are really changing very fast, investors looking into invest into open-ended funds should match their investment horizon with the fund's maturity, and our ultra short-term, low duration, and floater funds continue to look attractive for investors on a risk-adjusted basis. From a long-term debt allocation perspective, we believe our index debt funds present an opportunity, and if we were to look at the graph where we've done an empirical study of how returns on a 3-year CAGR basis have spanned out when yields have been in the range of 7 to 7.5%, you see that the 90 percentile return has been above 9%. So from a long-term debt allocation perspective, it makes sense for investors to allocate to index debt funds, matching their investment horizon. And since empirically these have given good returns, and you've seen yields have become elevated from the lows that you have seen. That's where we conclude our monthly outlook and look forward to seeing you again in our monthly outlook next month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।